we are looking at the market close to market day high, 24,634 on the Nifty. But it's pretty range bound as far as the market movement is concerned. But then let's talk about your portfolio and slightly longer strategies. And let's also figure out what fund managers are putting in their portfolio. We have Rupen Rajguru, Head of Equity Investment and Strategy, Julius Baer. Rupen, hi, afternoon and welcome to the show. All right, so let me just begin with the GST meeting that's underway. It's going on. A big Diwali Bonanza dhamaka are you expecting? And I also want to understand the way you are looking at the rollout and its impact in terms of portfolio strategies.
Yeah, hi. Afternoon, Kavita. So yes, we will get to know probably in less than 30 hours from now what exactly is the Bonanza all about. But if you were to just step back and look through, clearly consumption has seen a significant slowdown. If you look through the results of all the consumer-oriented companies for last 6 to 7 quarters, there has been a slowdown. And add to it, the possible tariff-related uncertainty which can impact the overall GDP growth. So from the both government and RBI's perspective, there is clearly, ideas to give stimulus to the economy. So by way of, direct tax cut as well as indirect tax cut. And we believe that should spur consumption growth. So yes, the mechanics, and I think I would closely observe about not only while the rate will be subsumed into two rates, and let's see, which all rates will come under 5 and then the other under 18%. But more importantly, also on the the compensation assess, how it gets, what are the mechanics around that. So net, at least from the government side, it is very clear that they want to spur consumption, and all these smaller mechanics about the GST related slabs as well as adjustment, we believe will augur well for the overall growth of the economy.
Hi, Ankur, this side. Point well taken. Of course, this is an event which needs to be watched out. But in next 2 to 3 months, is it a clear assessment that there is not much event to watch out for, meaning the only direction will come in when you come in the month of January, when actual data can be assessed? In that scenario, how should one navigate in the market? Should one currently park their money in the market or sit with cash?
Yeah, hi, afternoon, Ankur. So, if I were to look through an Indian market, currently for last 1 year has given zero or slightly negative returns. One of the key reasons for that is the earnings growth momentum has slowed down. And one of the reason for slowing also earnings growth momentum is the nominal GDP growth of India is now down to single digit. So as I explained earlier, government and RBI both are on full throttle to improve growth. And all that, whatever we are doing, the effect will be seen in next, probably from Q3 onwards, right, as you rightly said. But purely from a market perspective, this year, India has been a big relative underperformer vis-a-vis the globe. So globally, and in fact, we analyzed amongst the top 22 markets in the world as of August end this calendar year, we are the worst performing market in USD terms. So, and the underperformance vis-a-vis the emerging market is as high as almost 20% plus in last 1 year. So in that context, any good news on the tariff front can actually lead the market higher. So to answer your question, is this time to sit in cash? The answer is no, because what we believe majority of the negative news are there in the price. We hope and sincerely hope that by November or so, there would be a resolution on the tariff front. At least on that additional 25%, we might have some resolution around that. And once that is true, I think we might actually see a decent rally in the market because of our huge underperformance.
So on these lines, Rupen, what will be your sector calls and what themes are you positive on? I'm talking about a slightly positional and a longer term play that you're looking at.
Sure. So, Kavita, here I think one theme, one macro theme from an India perspective, which we believe, uh, at least both tactically in the near term and strategically also over longer term, which will play well, would be consumption, purely because of what I articulated earlier about the stimulus which both government and RBI has given. And within consumption, some of the automobiles are also one key part to that, because that has done nothing. If you see the auto sales, the two-wheeler sales, as we speak, is lower than what it was, on an annual basis in 2019. The PV sales have hardly seen any growth over 5-year period block. So that we believe should now start to look up. Also, some of the low ticket consumer discretionary items is where we believe there should be, because of the impetus, there should be reasonably better growth one can see. So that's one theme. The second theme, what we like here, Kavita, are those sectors, or those companies in which we are witnessing a consolidation, or the competitive intensity is reducing. So be it airline, be it telecom, to some extent, even the insurance side, which had a lot of regulatory headwind, and now that is behind us. So that these are some of the themes which we like from a medium to longer term perspective.
Right. I also want to get your view on IT and pharma. It has got renewed interest ever since rupee has started weakening, and more importantly, hospitals also. You maintain a neutral stance. Why?
See, IT, if you look through, globally, the trade is go long on AI and short on IT services, right? As that's the trade, at least so far in last few months, which has been working, which some reversal we are seeing in last a month or so. If you see Accenture and Genpact also globally versus, say, Nvidia, those have done differently performed. Uh, so IT as a sector, has a strong linkage with the US economy. So while because of tariff, initially we have seen a perk up, and the GDP numbers are better, but looking into the latest employment data and all, probably we'll wait and see, and we believe that US is in for some amount of slowdown, which can impact some of the IT names on the larger caps. But from a stock market perspective, usually IT, what we believe is, while we maintaining currently a neutral stance, but whenever large cap IT companies get into, say, around on a 1 year forward basis, closer to 19 to 20 P multiple, they actually become a tactical buy, because the dividend deal suddenly, looks very attractive. The free cash flow yield is very good, and those guys 80% payout is there. So there is a good base which is formed, and actually, historically 18 to 22 is a good band to buy it at around 18 and sell it around 20 to 23 on a 1 year forward basis, if there is no trend which is visible. So if there is a clear growth trend, if US gets into super boom time, the IT definitely will do well. But right now, that's not our base case scenario. So that's the one leg. uh, Pharma, on the other hand, no, while the noise flow around tariffs and all is there, uh, and pharma is again a very big sector. So within pharma, we do like some of the CDMO companies. We actually do like hospitals as well. So hospitals as a segment, we have been positive, and we believe that over next 2 to 3 years, the growth which we'll see in that segment is pretty good, and the RPOPs have gone up, and it's a good play on the overall uh, health insurance penetration also getting higher. So in a way also augurs well for the growth of hospitals. So within pharma, we do like hospitals. Amongst the US generic companies, probably on a case to case basis, there are some companies after the correction, it looks pretty attractive. So I would say it is, rather than currency might have some tactical play, or if any news flow around the US, specifically from the pharma perspective on the tariff front, might have some tactical play.
Right, Rupen. So that was a deeper insight. Thank you so much for taking your time out and helping our viewers with navigating their portfolio strategies today. Thank you. But we move on.